Hey guys, John Paulamy here, Actionable Intelligence. This is one of the first of many, I hope, shorter, more concise videos that I'll be putting out. I'm going to try to increase my workload. I know there's a desire for me to put out more videos, so I'm going to try to do that. I'm going to try to stick to some tight subject matter, timeliness. I'll also be doing the weekly market updates, but a lot of the videos were just too long, and it's better just to break up in subject matters. So, anyways, wanted to talk about is gold overbought? I think it is a little bit here. I've been an advocate for a gold bull market for several years, and certainly during the time that I've had the channel on YouTube, and while I've been publishing content on my blog and had the newsletter. And as you can see, this is a longer term chart, well, going back to maybe last year, 1 year chart. But you can see the progress we've made. We have a definite uptrend. We have the 200-day and the 50-day moving averages moving in the right direction. And the reason why I'm getting a little bit nervous about maybe putting on new positions in gold. Now, let me clarify. I'm a long-term gold bull. I think that, I'm not a gold bug, but I think we're going to have a tremendous gold bull market for reasons I've articulated in the past. But would I be putting new money in right now? Not sure I would. Why? Because everybody and his brother's now talking about gold. I mean, I've got all the usual suspects. I'm seeing a lot of things on Twitter, a lot of people jumping in and making a lot of comments, and a lot of people. It's on the front page, like Don Cox used to say, right? Don't buy the front page story, buy the page 14 story. So I've got my positions that I bought before these recent moves. I'm not selling them, but am I adding new positions? No, I am not. I just made a recent recommendation in the Actionable Intelligence Alert newsletter of a gold stock. I like producers that are generating cash flow and they have optionality. What I mean by that is they have properties around them that they can explore and increase their reserves. So a little bit nervous. Nothing goes straight up. We should know that, right? Nothing goes straight up, nothing goes straight down. But, we have the overall trend as our friend. But maybe if you don't have the positions on that you wanted, maybe you wait for a pullback, or maybe you take a third of your money and establish your position, then you wait for pullbacks. If you shoot your wad now, then this thing pulls back to 1750 or 1700 or whatever, then you're going to be disappointed, right? Because your stocks are probably going to drop about 25-30%, and you're going to be wanting to sell then. So something to take a look at. Not getting out of this mindset of a gold bull market, fully engaged. 3 to 5 years, this thing's going to make all-time highs. It's going to blow people's socks off, but not sure this is the right time to be putting new money in. Same thing with the gold stocks, right? This is the GDX. This is your larger gold miner ETF index. You saw the big drop. That's one thing I want to remind people. If you have a stock market crash because of liquidity concerns, you should have been a buyer down here. Would I be putting new money? Probably not. You're extended here on RSI. You're still probably could still move higher, but again, you're probably going to see a pullback. Nothing goes straight up. So just putting that warning out, because I'm just seeing too many of the usual suspects all of a sudden talking about gold, and that bothers me. Something most people aren't talking about, though, is oil. This is from a recent blog post from Goring and Rosenzweig, which I mentioned many times. Some of the best natural resource investors / research material, all free on their website. This is a recent blog post. And what you're looking at here is some work they did around the gold oil ratio going back to 1860 to 2020. And basically what we're saying here is that how many barrels of oil can you buy with an ounce of gold? And when you can get 30 barrels of oil for an ounce of gold or more, which is up here, gold is expensive relative to oil. When you can get it for 10 or less barrels, gold is cheap. So what they did is some analysis, and they said, I'll just read you this short blog post or snippet from the blog post. I will put a link to it in the show notes. I suggest you read it. Between 1900 and today, 1 ounce of gold has purchased 20 barrels of crude oil on average. That's the average, with a standard deviation of 8. As we mentioned, 80% of all observations are between 10, gold is cheap, and 30, oil is cheap. That's what they show here, 10 and 30. So most of the time is spent in here, okay? These are not the extremes. This is the average. According to historical distribution, a gold-oil ratio of 150, and now this is going back. This is going back when oil went negative, right, or when oil was extremely cheap during the coronavirus. This is what this was talking about. According to the historical distribution, a gold-oil ratio of 150 is an 8 standard deviation occurrence that is only expected once every 10,000 years. Clearly a black swan event, and we talked about that. We all acknowledge that. However, looking only when the gold-oil ratio has exceeded 30 to 1, again, when gold is expensive relative to oil, when it's 30 to 1, oil is cheap relative to gold, crude has returned 32% on average over the next 12 months. So when the gold-oil ratio is above 30, and you see it hasn't spent that much time above it, but when it has, your expected return for crude oil over the ensuing 12 months is 32% on average, while gold has returned 4% on average. So, right now gold is still up, so is oil, but we should expect to see oil move higher should outperform gold, is what I'm trying to say. That is what the data shows us. And we're all about setups here. We're all about data. We're all about what has worked in the past. History repeats, right? Success leaves clues. We're not just making this up as we go along. Oil was lower only 13% of the time when we exceeded the 30 to 1. So basically, on average, oil performed gold by 20% during these periods compared with 2% normally. So what we're saying is, if you do a calculation, you want to use 1,800 gold and 40 oil, you're still at 45, right? You're still up here. I mean, this has obviously come back since the oil prices rallied off the lows, but you're still at a ratio of 45 to 1. So we have an expectation that as long as the gold-oil ratio is above 30, we should see outperformance in crude, substantial outperformance relative to gold on a percentage basis. And that would tell us that we should be probably, instead of buying gold stocks, maybe we should be buying oil stocks. Obviously, I think that everything's going to be in a bull market, hard asset wise, but I think this is a good tool. It's a good something to look at. Okay, we want to buy things when everybody else isn't buying them. We don't want to buy when the crowd's buying. And like I said, sentiment is pretty high and pretty bullish on gold right now. Not sure I'm going to be putting new money there. I have been building a position in a oil producer that has all their production for 2020 hedged at $60 a barrel, and quite a bit of their production hedged for next year. So they have locked in cash flows. I'll be featuring that company in the August issue of the Actionable Intelligence Alert. So if you are interested in seeing that, not only that, this company has a stream of income from a recently purchased online production facility offshore Africa. In addition to that, they're taking that cash and they have many, many upside lottery tickets, drilling prospects around the world, offshore Guyana, offshore Africa, and any one of those could be a company maker. So that's the kind of things I'm looking for. And the stock is actually, fairly cheap relative to the cash flows they have now. So that's something that I am looking at. One thing I want to talk about, I talked about the Stephanie Kelton book the other day in a previous video, and the inflation that I anticipate coming down the pipeline. If we have an inflation, you need to think about something. Gold is not the best inflation hedge. It's actually energy, and then copper. And most people don't know this. And then if you look at broad commodities. So if you get a CPI, or consumer price inflation, which I expect, you can expect energy. And why is that? I mean, it makes intuitive sense, right? Energy permeates everything that we do. Now, gold will do well, obviously, but I don't think most people understand that in an inflationary environment, energy is the best performer. Something to keep in mind. Another thing I wanted to point out before I get off, everybody knows I'm big on the offshore oil sector. I think that, we got blown out of this position based on the coronavirus and Saudi Arabia, Russia spat, double whammy black swan that just basically took a giant dump on our heads. We had to get off. Right now, the offshore oil industry is uninvestable. However, it will eventually restructure, which is happening now. This is the point of this slide, showing you that's already starting to happen. The survivors will emerge from their restructurings with recapitalized balance sheets and stock, and they will then be, I think, tremendous, not only speculations, but investments. We're going to have to go offshore. The supply of rigs is getting taken down because of these restructurings. Here's Valaris, right? Offshore driller Valaris, former ENSCO, has just sent 3 drill ships, all less than 10 years old, to the scrapyard amid continued uncertainty in the offshore market. I mean, this is amazing. These ships, these are highly technical, very expensive ships, right? These things cost, like it says further in the article, each one of these ships was $750 million. So you're sending $2.25 billion of what they paid for these to the scrap yards, and these things are less than 10 years old. So that is the kind of restructuring that we needed to see in this industry. Now, I'm not saying Valaris is the company that comes out of this thing, but entities will emerge from this restructuring. They will emerge from these bankruptcies, and they will be investable again. And the industry will have shrunk, be restructured to a smaller size, but yet the demand for oil and the demand for the services we expect will be higher than the supply. We'll have a tremendous bull market. At least that's my thinking. When's the timing of this? We got to keep our finger on the pulse and watch it. It's not now, but it could be in a year and a half or 2 years. I don't know. But I just wanted to point this out because I'm cultivating this caper. I'm thinking about it. This thing has really got me mesmerized because this is exactly what we wanted to see. So just wanted to get this on your radar. But I will put a link to this blog post by Goring and Rosenzweig. Please take a look at it. This is what we look for. We look for setups that have worked in the past. We're not just out here blindly trading. If you're interested in how I take this kind of information and turn it into profitable stock picks and speculations, consider taking a subscription to the Actionable Intelligence Alert newsletter. They'll put a link in the show notes. All right, that's it. Thanks a lot, guys. Talk to you next time.